former life I was programming such SCADA systems, and in the meantime I'm heading the cyber portfolio of the treaty department in SCORE. So I moved into this market, and therefore I will leave the engineering market, but I will still remain connected to IMIA because we will launch a permanent working group in respect of cyber. The data and stats and benchmarking permanent working group will be handed over to Francesca. And Francesca is not alone. We have, in the meantime, a group of very knowledgeable people from an actuarial and also from an underwriting perspective. And most of the presentation will be run by these people because they did most of the work and interaction with Perils. We will give you updates on rate changes, loss ratio, what Dieter mentioned nicely. What is the beauty of the indices we show here? We all check them for correlation. So correlation between rate changes, loss ratio, correlation between mega losses and rate changes, correlation between mega losses and type of losses. Type of losses is a new index we are showing here about ground up contribution of different type of losses. We avoided the word cause of loss because when you start discussing what is really the cause, you will never end the discussion. So we have the type of loss, which is a ground up view from all losses, and the mega loss is really the headline losses, and we show their correlation. So I think the beauty of the indices we have, we could prove that from a different angles, when you're looking at the data we are producing, they correlate, and this is really a nice finding. My colleagues will explain you in a few minutes more about it. Shog, please, next page. Now, I was asked if we are now collecting so many different data, can we also, with all this data, do some predictions or monitoring and maybe implement an early warning system? And yes, I believe we can. So we have experienced a massive soft market in the past couple of years. I have to oppose to what our chairman Stefan has said. I mean, if we are really in a fun phase, has to be seen. But when I see the supply and demand assessment we did here, and when I heard Manuela earlier this morning, what the COVID situation did to the overall construction investment, which is in our market the demand, and the available PML capacity, which reduced in the past couple of years, but remained now stable, reduced from 2018 onwards, but remained now on a stable level. And when we think that we have now a massive reduction in investment, we have really to think about what is coming next. When you, Sharuk, go on the next slide, on the left-hand side, you see the gross domestic product globally from a global perspective since 2005 to 2020. And on the right-hand side, you see the contribution of the construction industry to the global GDP. They were always correlated. I will show you in a second that the correlation reduces more and more. But what is very interesting, that the financial crisis, 2008 to 2010, predominantly affected or over proportionally affected the construction industry between 2008 and 2010. And also important to understand, while the World Bank, these are World Bank data, is already assessing or identifying a clear GDP impact due to COVID, we have not yet data from the construction sector. So what Manuela was telling us is maybe ahead of the World Bank. Manuela, you're ahead of the World Bank. So there might be a dip, and potentially this dip could even be bigger than the dip on the overall GDP. When we now go on the next slide, we see in a percentage, from a percentage perspective, that in the past, the construction industry was adding roughly 1/3 to the global GDP, and this is shrinking. we are currently on a level of a quarter. This ends in 2019, could dip even more. So the dependency of the global GDP is less dependent on construction. The global economy is diversifying. We see a lot of digital values or industries creating value, and it's not all tangible goods anymore which add value to a GDP. So construction, importance of construction in respect of global GDP is shrinking. When we now go on the next page, we see here again, it's actually the same. We have seen 2 slides before, but in a different, we show here the percentage impact from kind of a baseline. And when we see the financial crisis 2008 onwards, then you see that we have minus 2% on the global GDP, but the industrial sector for the same period showed -5 to -6%. So we see here more impacted by the financial crisis. And again, Manuela is already ahead of time, or at least ahead of the World Bank. If 2020 will react the same way like the global GDP or potentially more, has to be seen. But this just as a side remark to the statement fun phase. We will see if this is really a fun phase. Keep in mind the capacity available remains stable. Next slide, please. This is now an overview. The yellow one is the GDP evolution over time, and you see that the blue one is the construction output in the same time or in the same period. It behaves similar, but normally more accentuated or stronger than the overall GDP. And what is especially interesting, 2008 onwards, when the financial crisis kicked in massively, interestingly, exactly in this time, we saw an increase in supply, in PML capacity supply. I assessed at least 30 to 50% plus. Down there you see a screenshot from Business Insurance that in 2013 several Lloyd's syndicates were putting or pulling their capacities together in the so-called Lloyd's Construction Consortium. But already before, we had via different markets, different regions. I remember very well the BRIC. I don't know if all of you have this word BRIC still in mind. Brazil, India, Russia, and China. So from all over the world, we saw increase in capacity of local markets, BRIC as an example, Middle East another example, and also global players and Lloyd's. So while 2008 to 2013 we had a dip in demand, we had an increase in supply. And these are exactly the ingredients for a soft market. And now maybe we have not an increase in capacity, but at least we have a dip in demand. So agreed, in the past 2 to 3 years, we saw a hardening market. It's up to you to decide, and with the slides following by my colleagues, you have to decide on your own if you consider that we are in a hard market or in a hardening market. But at least we should be prepared if it will be fun in the next couple of years with a shrinking demand has to be seen. Francesca, it's your turn. No, hold on. This is the last slide. I mean, when I keep in mind or when I refer to the Sigma presentation about engineering, which was published 2-3 years ago, they showed exactly in the phase I was showing you before, 2008 onwards, that all of us tried to keep our premium. We tried to keep our premium in a shrinking demand phase and in an increased supply phase, so increased capacities, shrinking demand, and as a consequence, shrinking rates. So what happened, we had in our portfolios more exposed risk. If we wanted to keep the premiums, we had to onboard more exposed risk with softer terms and conditions, and the result you will see now in the next 45 to 60 minutes presented by my colleagues, and then I hope you see the connection, and potentially this could also be the next index IMIA is implementing, monitoring capacity and the overall demand from an investment perspective. So enjoy, and I'm done for the IMIA Permanent Working Group stats, and I wish you all the best in future, and we stay tuned and connected. Thank you.
Thank you, Simon. I hope everyone can hear me. I guess so. So thanks for this engaging introduction and for, of course, the great efforts of establishing the Permanent Working Group. So good day, everyone, and thanks for attending the Stats Permanent Working Group presentation. Before we go into the exciting findings of the 2021 stats survey, just reminding on the housekeeping. If you have any question, you can put that in the chat, and we will answer at the end. We will have various presenters, so each of us will answer to your questions. If we run out of time, we will do it separately. On the next slide, if we can go to the next slide, obliged to refresh in all our minds the Antitrust Statement, and of course, in particular, that none of us is allowed to discuss or exchange any information on their respective company's intention concerning rates, individual claims adjustment, and cost containment practices. Now let's go into the survey with the next slide. So as many of you might recall, during the 2019 IMIA conference in Vienna, it was announced the IMIA 2025 vision to make the complex engineering insurance market tangible, with a mission for IMIA and Perils to produce reference points which help the engineering insurance market to benchmark their activities. At that time, it was Oscar and Stefan who decided to take on a fulfilling challenge of providing the engineering market with a rate change benchmark. And since then, Simon, together with the valuable contribution of Perils and the IMIA members participating in the survey, made the key announcement. And during last year's conference, it was announced the establishment of this Permanent Working Group. And since then, the group has worked very hard with Perils to provide the engineering market with a unique market reference, which we are going to share with you shortly. Of course, thanks to Oscar, Stefan, and Simon for your vision and passion, and for giving me the honor of chairing this working group. And thank you, Arne, Michael, Sharok, Sophie, Theodore, and Yepin, for your commitment and valuable contribution. Shortly, you will hear from most of them, and so you get to know them directly. So with that, let's go shortly in the process to give you the background of this exercise. So which are the IMIA statistics Permanent Working Group benchmarks? So the rate change and loss ratio and mega loss indices as presented last year. And what is new for 2021 is the type of loss. And with those indices, IMIA shares with transparency a better understanding of the engineering market history and provides all of us a benchmark to our portfolios. It's key to remind that in accordance to the data protection and antitrust law, IMIA doesn't have access to raw data. And for this purpose, all participants' companies provide their data to an independent party, Perils, and Perils signs NDAs when requested, and then aggregate the data for IMIA. Now, before leaving the stage to the working group members responsible for each index, I will shortly give you the context of this year's findings with the next slide. So We made a comparison already last year. According to the Swiss Re Sigma 2018, the global gross written premium for engineering is between 20 and 30 billion US dollars. Some of our contributors this year evaluated that range slightly lower, but still in the range around 20 billion. The good success this year is that we had almost 60% of the IMIA members contributing to the survey. And of course, we aim to increase this participation every year because it's only thanks to that that this working group can provide you with such insights. So in terms of gross written premium, our statistic represents 60% project business and 40% of annual, which is almost in line with the 50-50 we have from the Swiss Re Sigma. I think the important difference which has to be highlighted this year is the split between global and regional contributions premium-wise. So while last year we had a ratio 60-40 between global and regional, this year we have 90-10. So there is a definitely predominant contribution from global markets. On the loss ratio index as well as on the rate change, the numbers are benchmarked against 10% of the market premium. And in terms of contributions, all the indices are benchmarked to more than 10 companies. On the mega loss, this year we have more losses to look at, and Sharak will guide you into that insight. On the last index, which is new this year, so the type of loss, we have a slightly lower contribution, but we are confident that will improve for next year and we can bring all those contributions to a higher level. So with the next slide, I'm going to quickly show you what is new this year. You have probably have seen that this year we have optimized the survey while compiling the different surveys into one. And in the next weeks, we will also run a poll about the 2021 survey, which we would really like you to contribute to in order for us to evaluate how can we further improve and which are additional needs we can address with this within the working group. Last year, we anticipated the negative correlation between rate change and loss ratio, and happily this year we are able to show our findings, confirming with figures what we all could have expected. On the type of loss, this was an idea launched during last year's conference, and this year we will already share key aspects to benchmark your portfolio too. And while working on the type of loss and the mega loss, we found some interesting correlations, which we are going to show you shortly. And with that, I leave the stage to the group, starting with Michael to deep dive into the details of the rate change. Thank you. Over to you, Michael.
Thanks, Francesca, and hello, everyone. So if you just move to the next slide, Sharak. As Francesca mentioned, I'll be taking us through the results of the Emea rate change index. And if we move to the next slide, we just have a brief introduction and a background about the methodology used in the survey. So for those unaware, the Emea rate change index is an index that's been published for Emea for the engineering market for the last number of years, and it covers the period 2002 to 2021. This is broken down into sublines, so it's split by project and operational business, but it's also split by territorial scope. So split by global business and also regional or local treaties. Since the list of contributors changes every year, we'd expect some slight deviations in the results from last year, but the overall trend should remain fairly similar. Just a brief background on how we conduct the survey, or how Perils combines it together. So contributors are asked to enter the rate per mil that they would have charged for business at 6 historical points in time, and they put this in for 6 separate sublines, 3 operational, 3 project, and then we also ask them to put in an expectation for the forthcoming year. Then the index is set to 100 for the underwriting year 2010, and then the rate change is calculated relative to this year. So it's important to highlight here that the underwriting year 2010 is chosen arbitrarily, and any underwriting year could be set to 100. So we're not saying that 2010 is when the market was hard. It's just a line in the sand to calculate the index and the rate change for the other years. And then a simple average is used when combining the results from the individual contributors. So this basically means no matter the size in terms of premium, that every contributor's answers are given an equal weight in the survey. So if we move on to the next slide, we can see the results from this year. And as you can see, similar to last year, there's negative rate decreases from 2002 to 2018. And this is when the market started to harden, or it changed, and we have significant rate increases for 18, 19, and 20. You can see that it varies slightly by the various sublines, but overall, a similar kind of trend. So if we move on to the next slide, we can see the comparison of this year's results to last year. And we'll also delve into the comparisons that are more granular, so operational, project, and global and regional in some later slides. But overall, you can see that the trend is relatively the same, but the key differences this year is that the rate decreases from 2010 to 2018, the magnitude of them decreases has reduced relative to last year. But then in the more recent years, the rate increases in 2019, 20, and 21 are greater than last year. So the kind of observed rate change is higher than expected. So if we move to the next slide, we'll look into some of the drivers of them differences we've seen in the overall graph. So as Francesca mentioned, the contributions this year were split 90% global and 10% regional. So it was heavily weighted towards global companies in this year's results. So in the graphs here, so on the blue line, you can see the results from last year. And then in the yellow is this year's results for the global on the left, and then this year's results for the regional is on green on the right. Beginning with the global, I think the overall trend is very similar to what we've seen last year. There's some slight differences in the rate decreases between 2010 to 2018. So similar in the overall graph, the magnitude of these decreases has reduced this year, and then a slight increase in the rate increases in the more recent years. But then in the regional graph, it's a very different picture. So there's been a flattening of the curve this year. So them rate decreases, the magnitude has decreased significantly. And I mean, it's pretty illustrative in the graphs that while the global market is seeing significant rate increases, the regional markets are still seeing year-on-year rate decreases from 2002 to 2021. And I think it's important to note that some of these regional treaties or clients may not have been impacted to the same degree as the global cedents, who may have been impacted by these large market losses. I'm sure that everyone's aware of in recent years. And also the level of capacity in the market in these different regions is going to have a key impact on the trends that we're looking at in these graphs. So if we move to the next slide, we can see it's split by project and operational business. So in the left, we have in blue is last year's result for the project, and I think it's in orange on the graph on the right. So looking at the project business first, a similar trend to what we've seen for the global. These rate decreases from 2010 to 2018, the magnitudes decreased, but then the rate increases are significantly higher, I would say, than what was forecast last year. And then the shape of the operational curve, kind of similar to what we've seen for the regional, it's flattened quite significantly. So the magnitude of them rate decreases is a lot less than what we've seen last year. But the increases for 2018 and 2019 and 20 are broadly in line with those forecasted last year. So if we just have a quick summary of the points on this slide, I think the takeaway message is that there's been a gradual decrease in the rate decreases, or the magnitude of the rate decreases, from 2010 to 2018, but then an increase in the rate increases in the more recent years. This is driven by the operational and regional business, significantly flatter when compared with last year, but then these rate increases, so the observed, has been higher than expected for the global and project business. One caveat with these comparisons that we were looking at, that in last year's survey there was no data point collected for the 2018 underwriting year, so this may cause some distortion in the curves when comparing, as it's likely maybe people's opinion of 2018 may also have been at a low point. But as a conclusion, in 2021, the level of the index now is sitting equivalent to a level of 2011 and 2012, so around 92.36. And this is just when we take a simple average across all sublines. But this is a comparison to a level of 126.9 in the underwriting year 2002. So I think the key takeaway point is that although we've seen rate increases in the last few years, prior to 2018, there's been significant rate decreases for over 15 years. And on that point, I'll pass you over to Sophie, who will take you through the loss ratio benchmark survey. Thanks.
Thanks, Michael. So the next section will cover the analysis of the loss ratio development per underwriting year. So in the survey, we requested gross written premium and gross incurred development triangles per underwriting year. And thanks to those triangles, we were able to build combined triangles for all the market participants of the loss ratio developments. So this triangle includes the data of the 13 contributors and represents a little bit less than 2 billion premium, which is quite good. And we have so we observe mostly the last diagonal. If you look at the last diagonal of the triangle, which represents the current incurred over written premium position, so not the ultimate position. There is no IBNR in our triangle. It's only the incurred over the written premium. And what we can see, nevertheless, is that for underwriting year 2015 to 2016, we already show loss ratio above 65%. And those are expected to deteriorate further, so as we don't think they've reached full maturity. So they are already at 65. And the underwriting year 2017 to 2020, they are below 60% for now, but similarly, we expect them to deteriorate further. In terms of the development of those loss ratio, we observe jumps. Those are explained by the large losses, especially in 2011, we can see it quite well, and more recently in 2014 to 2016. And the final thing we noted on those triangles and those developments is that the recent underwriting years, they show higher loss ratios quicker than the older underwriting year. This is what is showing with the red arrow on the table. And this could be explained by two factors. So it could be that the recent underwriting years have shorter durations of policies, or it could also be an early indication that those recent years will reach a higher ultimate loss ratio. So next slide, please. So those graphs displayed here, they are just a graphical representation of the loss ratio triangle we just looked at. And each line represents the development of one underwriting year. And we did a zoom. So the graph on the right-hand side is a zoom of the big one, where we wanted, so you can clearly see the line at 60% loss ratio. And you see the underwriting year that are above that 60% loss ratio line. And the other thing that you can nicely see on the graph is the fastest development of the recent underwriting year, with a steeper development than the older underwriting years that were showing lower loss ratio at the same point in time. Another thing to keep in mind is that here we are looking at loss ratios. So it's not the end story. We need to consider combined ratio, which is the sum of those loss ratio plus your external and internal expenses, as well as the cost of capital. So next slide, please. So the next section is about the relationship between the rate change and the loss ratio. That's the new piece of analysis that we carried out in 2021, as Francesca mentioned. So in the past, we've observed that when the loss ratios were going up, we could see the rates going down at the same time. The loss ratio index at the top show already high loss ratios on recent years, so 2017 to 2019, and those years they also match the bottom of the rate level index, especially 2018, which is where we had the lowest rate level, and we have a pretty high incurred loss ratio to date at 54% after only 3 years of development. So in order to analyze the relationship between those two indices, so the loss ratio index and the rate index, we calculated ultimate loss ratios using the loss ratio triangles, and we compared those to the rate level index, and we found that the two indices were strongly correlated. And that's what you see on the graph on the right, that when one curve goes down, the other one goes up. So on the graph, we compare the ultimate loss ratio, which is the blue line, and so blue dots, and the orange dots represent the rate index. And you can really see that they move in opposite directions. And we calculated the correlation factor between those two lines, and we find a negative correlation factor, which is pretty high, of between 80 and 90%, depending on how many years we included in that analysis. So that's nice proof that there is definitely a correlation between those two index. So Michael showed you earlier that at the moment we are currently experiencing increasing rates since 2018. So we are now at the level of 2011, 2012, where the loss ratio to date is 60%. Those loss ratios, they remain volatile, obviously. We saw it in the triangle. They are strongly impacted by very large losses. So in our analysis, we've had to ignore, for example, underwriting year 2011 because of the large hydro loss in Colombia, sorry. So that's all we wanted to show you about the loss ratio index and the rate change index. And in the next section, Sharuk will tell you more about the measure loss and how it ties back to those loss ratio we've just observed. So I'm now handing over to Sharuk. Thank you.
Thank you, Sophie, and hello, everybody. So I will go shortly through Emea Mega Loss Index, and for this we focus on losses above $30 million. Our list is including about 130 losses since 1991, in total around $12.5 billion untrended. For this analysis, we were working only on CAR, EAR losses, and we went through both occurrence years and underwriting years. Our list is based on best estimate from ground-up loss amounts, split by type of risk, nat cat, geography, and type of losses. As you see, since 2010, on occurrence year basis, both frequency and severity of large losses have been increased, while for about 20 years between 1991 to 2009, the simple trended by 2.5% per annum average total loss per year was 195 million. In the last 12 years, since 2010, increased by almost 5 times to 991 million. This increase was both on PD and LOPDSU sides, but sharper on LOPDSUs, which has been increased from 4.2 million average per year before 2010 to about 126 million after 2010. Just to understand the trend change for LOPDSU losses, it's good to know that before 2010, there was only one loss including LOPDSU at $50 million US, and after 2010, 18 losses in total, 1.26 billion. When we go through the list, it's clear that both frequency and severity of losses has been increased after 2009-2010, especially in some occupancies like buildings from 6 losses total 400 million to 27 losses total 2.2 billion. Hydros from 2 losses total 180 million to 14 losses to total 2.3 billion. LNG and petro industry 5 losses at 400 million to 16 losses at 1.75 billion. And power plants 2 losses at 140 million to 21 losses at 2.1 billion. Frequency and severity also increased in fire and explosion, water damage, internal and external, and collapse after 2009-2010. The main reason for this jump and
Joe, can you move to the next? Are you on the next slide, right?
I mean, I'm still here, but we can see the frequency increase next slide as well. Yeah, I just wanted to mention the jump between this 2009 to 2010. Is the major reason is bigger projects with higher total sum insured, more complex projects, longer projects with tighter schedule, increased number of projects and developments at the same time, and in addition going through soft market which increased competition leading to wider coverage, lower deductible, and insufficient premium. Here you can see the increase of frequency of losses starting from 2006-2007 and settled in higher level in 2009-2010. The harsh increase in the number in the large losses in 2018 lead to capacity withdrawn plus increasing transparency and market awareness by Emea was a turning point in the market. Last year, maybe due to COVID, was less active, and this year is fine for now, but we have only one loss in our list. But we know that it would be more, 2-3 more losses would be included, but for the moment we skipped them because we didn't have enough information. In this graph also you can realize that the frequency and severity of large losses increase through underwriting years as well. This follows the occurrence years pattern with about 3 years waiting period. And more recent underwriting years here still need to be developed. So we expect financial year results remain under pressure in next few years. And again, number of aggregate losses based on underwriting year. And this is also clear here that there is an increasing trend on the frequency of large losses since 2006-2007 underwriting year. When we dig in mega loss list from different angles, we might receive interesting information showing us some sort of trends or findings. which we can use in our daily underwriting activities. I'm not going to details, but here you can see some illustrative charts for your attention. And in this page, you see the split Nat Cat and man-made losses from the type of risk, type of loss, and territory point of view. 24% of total losses are Nat Cat, and the rest is man-made. You see also a split of aggregate loss amounts between Nat Cat and man-made on underwriting year basis and also on occurrence year basis here. What is more highlighted is that almost each and every underwriting year and occurrence year we had Nat Cat events, despite that the contribution of Nat Cat losses is much lower than man-made losses. So it means that frequency in terms of Nat Cat is more concerned. And in this slide, you see the large loss split between the territories, and it shows that almost every territory contribute the same, around 20% of large losses. In the next slide, you see the type of risk. The large loss list is split between type of risks. And some occupancies, you can see that they are more dominate on contribution on mega losses, such as hydro and LNG and petro industry from severity point of view, and building and power plant from frequency point of view. And from finally, from type of loss point of view, fire and explosion with 26%, collapse 23%, water damage in internal and external 16%, our biggest contributor to the mega losses. And together with wind at 7%, ground condition and corrosion each 5%, they are around 80% of total mega losses. So with this, I will hand over to Theodore to go through the IMIA loss analysis. Theodore, the stage is yours.
Thank you. So apologies, everyone. I've got a similar issue to Simon where I can't log in via the laptop, so I'm on through my phone, but hopefully everyone can hear me okay. So yes. This is the ITIL, the new type of loss index. And first of all, what I'd like to do is just say an enormous thank you to all those who contributed and provided their loss data. This is the first time we've actually been able to gather data like this, so it's a huge milestone for ourselves as a global engineering insurance industry, and hopefully this gives us a great insight into how the market's performing and will help us to benchmark ourselves as individual carriers. So if we go on to the next slide. So we had 14 usable data sets out of the 18 overall participants in the survey. And what we have through that is an aggregated loss total of about $10.5 billion US, which roughly equates to about 6% of the global engineering market. So not an insignificant chunk at all. The losses, someone touched on, all ground up from 2008 to 2020, and they're across the three sectors of operational, project, and IDI, and there's some definitions as to what we mean by operational and project underneath there. Moving on to the right-hand side, these are all basically, we thought it was important to give you an appreciation for the underlying data here and the makeup of the portfolios that are contributing to these results. So what we have is a rough 50-50 split between operational and project losses, about a 20-80 split for regional to global. So the vast majority will be global loss results. And then a healthy mix as to premium portfolio size, with the majority at less than 50 million, but 4 above 200 million. So a nice split there. And with the bulk of these aggregated loss portfolios at just under $1 billion, or between that 100 million to $1 billion range. If we go on to the next slide. This is the first iteration of our index. So we wanted to keep it as simple as possible, and also to just try to make it easy and as easy as possible to encourage participation as well. So we've got 6 umbrella terms here, and we weren't really, like Simon said, we're looking for RCAs, but the major influencing factors of these claims. So we have 6 umbrella terms with a relatively even split across the board, but with meteorological losses leading with that 26%. We do break these umbrella terms down. So if we go on to the next slide, we've got much nicer breakdown of these, and what we can see here is the full breakdown of what we mean by meteorological, static, chemical, human, and material. So the sort of red boxes here are just encapsulating the major participating loss factors that are above 10%. So we've got external, water and flood, fire and explosion, faulty design and workmanship, and mechanical breakdown. Now you'll see that other is there at 13%, but obviously it's there as a major contributor, but we tend to have the general feedback that this is a labeling issue. There's a problem rife throughout the insurance industry, and something that needs to be delved into, because like Dieter mentioned, we're not going to get any benefit from labeling or any insight from labeling losses as other. So on to the next one. Like we said, we wanted to compare those results with those from the mega loss index, and what we see here is a much more significant weighting to static and chemical losses, which is probably fairly unsurprising. But interestingly enough, the meteorological losses have remained consistently large there. And of course, TPL has fallen away from the mega loss index there. If we go on to the next slide, again, just to delve into these a little bit further, the external water, the major common participating factors across those 2 indices, along with fire and explosion. So that was very much a quick whistle-stop tour, and I will now pass you on to Simon, who's going to be wrapping up.
Yes, if you could quickly stay on this slide. I mean, first of all, thank you to the entire permanent working group. I think absolutely magnificent job what you did here. I'm deeply impressed what you did, and I'm really happy that I can hand over in such knowledgeable hands. Maybe just one side remark: when you see here both IMIA type of loss and IMIA mega loss index, I mean, I remember all these very academic discussions about earthquake and terrorism and whatever. I mean, our bread and butter business is eating away our premium. This just that everybody keeps this in mind when we negotiate terms and conditions. We can discuss a lot about TPL during maintenance and all that stuff. It's of course important, but bread and butter, water, fire, this is what erodes predominantly our premium. It's okay. I mean, we are there for this. This is the intention of our industry, but just where we could have quick wins, where we potentially could also contribute to policyholders because we tell them how to protect them better against water or fire. These are definitely two types of loss, avoiding the word cause of loss, types of loss where we could do best to our industry and potentially also the society. I think this is my takeaway of IMIA type of loss and IMIA mega loss with all the other important factors. We heard about the DSU, we heard about the low deductibles, etc. But this, everybody should keep in mind, this is driving here the scene. Then when you could go on the next slide, the conclusion. I mean, yes, key takeaways. I did not do this slide, so that's why Francesca had to run to another meeting. That's why I'm doing it for her. But I think the key takeaways are obvious. First of all, what we could show here, that all the indices, they have correlation with each other. And when you go on a bigger picture, I showed you the macroeconomic environment. The macroeconomic environment is driving, at the end of the day, the terms and conditions. This is not surprising, but we could show directly the correlation. So demand on an investment side, available capacity, driving rates down, terms and conditions down, increasing loss ratio, widening terms and conditions, leading to more mega losses, higher frequency, higher severity, and overall also the bread and butter, what insurance is meant for, fire and water, is eating a lot of, so I would say our standard business is already eating a lot of our premium. So for the very exotic losses, there is simply not enough premium left to stay in a green, I have antitrust wise to avoid profitable, but to remain in a green area where we have all a fun phase. I would say at least the past was not very fun. Currently, I observe a few ingredients that it won't turn into fun phase so quickly from a financial and an underwriting year perspective. Yes, 18 markets contributing. I think for IMIA it's good, so the participation via IMIA is great, but what Stefan mentioned in the beginning, we would like to get more feedback from the regions. So local feedbacks would be highly appreciated, and this would also be one of the contributions to local engineering markets to improve understanding, because most of them, they combine it with property or other lines of business, the way they underwrite it, the way they account it, and the way they produce statistics. So they have normally not an underwriting view, and they miss completely the development of their long-term business, because they look just at it year by year, and then they're surprised that after 5, 6 years, they've all of a sudden big loss because of a fire or whatever explosion. They mean it's volatility, but at the end of the day, it's just developing of their portfolio. So their regional markets, I hope we could motivate, and we have to further invest that local market contributes more. Is there anything else on the? Is there another key takeaway? Shauk?
I think one of the main messages that we had since 2018 increase and positive rate changes, but we are still at a level of 2011-2012, which means that it needs to be improved. Market needs to be improved for more few years to be back in a hard market. So it's hardening, it's not hard market yet, and we need more few years to bring back the sustainability to the market.
Thank you. Is there another page?
We haven't got any questions. There aren't any questions. I think there's a huge amount of information to absorb and work at. I must say it's a very, very interesting presentation. I think the guys have done a huge amount of work, and it's one of the biggest contributions Emea is making to the market at the moment. Very well done.
Thank you.
You seem to have more slides there. Ah, okay.
No, we'll go back to the beginning. Okay.
No, I think it's okay. We mentioned all this.
Yeah.
Driver.
I think the thing is also, while we've got all our members online, those who aren't contributing to think about adding their contribution to this database, and it will make it all the more interesting and the more valuable. Especially regional markets. It looks like if we could have more regional, local contributors, that would be fantastic.
So thank you. We are done.
Yeah. So you're done. So shall I, Simon?
Thank you very much to all of you.
Yeah. Yeah.
Just give me a second, Mike. I just wanted to say thank you to all of you, those who have presented today. Francesca and Sophie, Michael, Sherrock, great presentation, wonderful. To all others who have contributed, and I know the permanent working group is much bigger, I would like to motivate you to stay on and to keep repeating that kind of exercise for IMIA in the next years. Hopefully, Simon, if you are not in the fun phase of underwriting yet, you had some fun in doing these kind of analysis.